All right, analyst members, welcome. This is our second meeting for the FA, and in case you guys weren't here for the last meeting, we went over asset classes and the IPO process. But just to remind you guys, we're going to go over some few slides that will be good for you guys to know. All right, next. All right, so today's topic is going to be Intro to SEC Filings and Financial Accounting, Part 1. So, yeah, you guys are going to learn about the different filings. Very cool. Before we continue any further, I would like to read this risk disclosure. So, as it states, all R&T events as well as analyst meetings are for educational purposes only. They should not guide your investing or investing decisions. And yeah, you should always proceed with caution and do your own due diligence before you invest in any securities. But yeah, you cannot sue us. You guys lose money. Here's today's agenda. We're going to go over the FA analyst organization information since I'm assuming that none of you guys watched the first video yet.
It's okay. Don't worry about it.
That's all right. And then we're going to talk about the financial statements, go over a brief overview of them, then segue into SEC filings, the ratios, and then go over any announcements that are important to know.
Yeah, and the reason why this agenda works is because with the financial statements, a lot of these ratios, all the calculations you're going to get are from these financial statements. So it will show you how to find all that information. It's real easy. It's not going to be very hard, so don't worry about it.
I did it last night.
Yep.
Very simple. Okay, so our analyst organization information.
This is our analyst team.
As I previously stated at the last analyst meeting, all of the members on this team have been hand-selected by me. They are very well expertised, and they possess a lot of knowledge, and that's exactly why I picked them out to be my managers. He's been put through a very rigorous interviewing process, and yeah, he knows a lot of stuff about investment banking. That's why he's on my team.
We had another person, however, they were not able to participate this semester due to timing differences.
We don't know his whereabouts as
we think
right now.
We think he's in South America. The last we heard is he was being chased down by the tribes. We don't know what happened to him.
He's gone now, but he was supposed to be your third manager.
Yeah.
Okay, our mission and vision. So as I stated in the Discord server, the whole entire purpose of this program is for it to be education focused. And the whole goal of it is for you to be more critical thinking retail investors, which is why I'm going over all these topics.
Our slogan today is frustration is innovation.
Explain that.
So obviously with frustration, right? Y'all are in the middle of studying for finals. You're in the midst of doing something new. Maybe you're not always going to get the best results right away. I mean, the greatest things take time. If you were to put progress on a slope, it's not a straight line, right? Now, that's a good quote, assuming you're making progress and you're able to overcome that frustration. That's what this is for. It's not always the case, though.
That was a very nice explanation.
Mm-hmm.
Here are our goals illustrated: professional development, financial education, enhanced critical thinking. That's our goals for the analyst team program.
Yeah, it's simple, so that way we can help you.
And now we're going to get into today's topic, which I will let John Hammond present.
Okay, so we have 4 of the main financial statements to go over, and this is in that order. So if y'all are wondering if this is out of order, no, this is definitely, and this is the way it's going to be shown when I show you the J.P. Morgan financial statements. However, due to time, I may not be able to do it on this recording, so I'll end the recording and then we'll go over it. Okay, so we're going to go through it and then we'll do that at the end. So we have 4 statements to talk about today, which is the balance sheet, the income statement, the statement of cash flows, and finally, the statement of stockholders' equity.
Oh yeah, if you guys have any questions at any time, don't be afraid to raise your hand.
Yeah, that's true. Okay, so I will say though, for the statement of stockholders' equity, y'all are probably not going to use a model for that. That's just basically a way of showing what the shareholders have owned, less distributions, in other words, dividends, that they have not paid over the life of the company. All right, so the balance sheet is the first one, and like I said, we're going to go over a live example later, so I'm just going to go into very basic details. The balance sheet is an overall snapshot of the company's, assets and liabilities at a point in time. A good example of our accounting equation as an accounting major, you have to know that. It's assets equals liabilities plus stockholders' equity. Can anybody tell me if your assets Financial liabilities is negative. Does anybody think that's a good thing? No? Okay, can anybody tell me why?
Well, because my liability is it's sort of like step, and if it's careful, then you actually owe a lot more money, not like keeping money.
Okay, that's good. Good. Emily?
So the balance sheet just has to be balanced, so it's like negative on one side, but positive on the other.
No, so what
I know.
I'm asking is like, so if I subtract total assets from total liabilities on the balance sheet, I'll show you,
Oh,
and it's negative, do you think that's a good thing?
oh no.
And I guess Rio talked about what that could indicate. That was going to be my next question, but okay. So it's basically, what's it called? It also shows what creditors are entitled to. In other words, that's your liabilities, and your resources are the assets the shareholders are entitled to. That's all you need to know for that right now. And then the income statement is overall profit and losses at point in time. We're going to look at an annual, but you can look at it quarterly. But we're going to talk about the two types of reports you're going to get. There's one that's done every year, and then there's one that's done like four times a year, because there's 4 quarters in a year. And also what you should know about that is that sometimes you may look at a company's financial statement, and it may not be from January till December, depending on their accounting cycle. They could end their accounting cycle in like May or in like March, depending on when they released it. So that's why if you see 2024 and you don't see a 2024 annual report, that's the reason why it hasn't ended yet for them. There you go. Statement of cash flows. This is very important. You can reconstruct the other financial statements using this one alone. And the reason why is because all these accounts connect. Good example is a common account on there is net income. Y'all know what net income is? Okay. So basically for the statement of cash flows, for operation cash flows, cash inflows and outflows, you're going to take your net income, you're going to add back your, your non-cash expenses. So like, can anybody name me a major? I'll be impressed if you can. And major like non-cash item that we all have to learn about. Good, very good. Can you all name another one? Come on. It's in the same ballpark, but it goes by another name.
Amortization. Dude, I'm sorry. Couldn't help myself.
Okay, cool. I was just curious if you could. I was gonna say I'll be surprised if you could. But yes, it is amortization, Vincent. Thank you for your help.
Sorry about that.
Financing so it breaks down into 3 activities. There's operating, there's financing, and investing. Financing is, self-explanatory. It's where the business gets its money to finance its operations. That includes debt and equity. Does anybody know what equity is? Can you name like what an equity? Think about Vincent. Don't go. Stocks, good. Okay, so what is a stock? I know you didn't watch the last video, but can you tell me briefly what it is?
Something like a share of a company, so like part of it.
Okay, share in a company. Good. Ria, can you name another equity?
Yeah.
Okay. Preferred stock would have been another good one. That's all. If you look at the balance sheet, which I'll show you, that's all listed in order under stockholders' equity. Let's see. Then there's investing. So a good example is property, plant, and equipment. That will go under there. If I buy a building, that's where it will go under. Let's see. And then there's a statement of stockholders' equity. Like I said, you're not really going to use this for a model. I have never seen a model use this. If there is a model out there that y'all find that use that, bring that in. I want to study that. I want to know why they want to use it. But essentially, it's the the health of the equity accounts in a snapshot in time. Again, we're going to use one annual statement, so over the life of the company. So a good example, if I started in 2020 and my current year is 2040, that's over 20. That's basically over 20 years. That's what I'm trying to say. Let's see what else. Balance sheet. Yep, all these accounts are connected. That's why you should know the financial statements are all connected. So, and then there's the SEC filings. Cool. So now we went into the process of an IPO last time. However, if y'all aren't aware what an IPO is, it's just basically when a company offers shares to the public for the first time. So we didn't go over the documents for that, though. We're going to go over some documents today. So here's a brief lesson we have for the SEC. The reason why, because I know a lot of classes like to tell y'all, you need to learn this, it's important, but they don't tell you why. So basically, the reason why is because of the Roaring 20s. a lot of fraud, misstatements. I know what you're thinking. Did the government invent the prospectus? No, it did not. I know I was just as shocked as y'all when I read the Sixth Great Power. I realized that there were prospectuses that are 100 years old, so it's as old as time. Then there's what followed the October 1929 crash was the Securities Act of 1933 that basically put in place the SEC and the initial public offering documents that we need to add to the primary market, and the Securities Exchange Act of 1934 were the follow-up documents like the quarterly and the 10Ks that y'all need to initiate every year. So it's basically regulation for the secondary market. If I'm going too fast, also let me know because
Do you mind explaining what you mentioned?
10K?
Yeah.
We're going to go into that in a minute. It's just one of the documents basically that we have.
Yeah, once a company IPOs, basically he's saying like they need to inform their investors about their financial standing, that kind of stuff.
Right. There's certain documents every year that a company needs to do, and they need to file it on time. Y'all know the auditing and stuff like that. You've heard of that? Okay, that's part of that process. And if they don't do that on time, they could get threats from the SEC to delist their stock. So it's seen it happen many times before. And here's the section. I've decided to break it down into the the financial statements, news and events, insider trading events, and the IPO filings. I mean, all I have is the S1 prospectus because all the documents that we were going to talk about go into there. Okay, we'll go over the financial statements real quick. So this is where you're going to pull the bulk of your information when you're creating the model, the 10K. That's where the profit and loss, balance sheet, cash flow statement, and statement of stockholders' equity are. The 10Q, if we'll also give this to y'all so you can look at it as well. It's not just going to be one and done. You'll be able to ask questions as well. Go ahead.
Oh, I was about to say like there's three 10Qs and then like the fourth one is a 10K.
Really?
Yeah.
Oh. This is the basic one then we're going over.
Yeah, but pretty much a 10K is like a more comprehensive 10Q. There's like three 10Qs and then it topped it off by a 10K.
Yeah.
Because you guys know why, right? There's 4 quarters.
Yeah.
Yeah.
So then there's technically 4. Which is 3 every 3 months. You said there are 3 10Qs.
Don't quote me, man. I just know there's 3 10Qs and a 10K.
I thought he was saying for a minute that there were 3 different types. I was like, what are you talking about?
No. I was just saying there's 3 10Qs and a 10K within a year.
Yeah.
So why would there be 4 and then plus the annual?
There is 4.
The fourth one is the 10K.
Okay, so then
Yeah.
I got it.
Got it?
Yeah, okay. But before Vincent made a good point, the 10Q is released quarterly. So in other words, that's how most people break down, or most companies break down their accounting cycle is quarterly, which is, if you don't know, a quarter is 3 months. So it's just to let you know. Okay, so companies, whenever they want to release information, they usually will release the 2 types of documents, an 8K, or an 8K, sorry. It doesn't sound like I said 8K, my bad. Which is basically a nice way of saying it's a press release. All the unscheduled events and important news like acquisitions and mergers would go through that. Proxy statement, that's before the annual shareholders meeting. That's basically a nice way of informing the shareholders, hey, this is what we're going to vote on. That could include board of directors, executive compensation, certain mergers and acquisition events, and earnings statements. So that's what that is. And then there's the insider trading. Oh yes, so insider trading has been very highly regulated. However, if you own more than 5% of a company, you're required to report if you buy or sell securities in that company. In other words, stocks and I think not bonds too, but there's a different filing I think for that. So the basic one is the initial one that was for Form 3, which is the IPO filing, because the company wants to know who owns it. Why, or the SEC wants to know who owns it. Why do they own it? Who's the interested party here? Form 4. This is more of what you're going to see on a regular basis. That's the secondary offering or the secondary market that we're talking about, where if a company if an insider in a company is buying and selling shares, then that's where they'll report it. We're going to look at that today as well. Form 5 is an annual summary of Form 4. Form 144, I've never seen that. Corporate disclosure of public stock insider selling report. Schedule 13D, I've not seen that either, is a beneficial ownership report. Okay. And the last IPO filing, or the last filing we have is the IPO filings, which is the S1, the prospectus. This is basically all the information you need to make a decision about a company. This is their financials. What do they do? what the proceeds are going to be raised for, how much debt they're going to have, executive compensation, that sort of deal. And I think it's all to you for the financial ratios.
All right, now that you know about the 10Ks and 10Qs and the financial statements, we're going to talk about the financial ratios, which are metrics that you could derive from these financial statements.
Mm-hmm.
All right, so here's some common ratios in their categories. So I'm going to start off with top to bottom. We got your liquidity ratios. These liquidity ratios are basically financial metrics that are used to determine how easily a company can pay off its debt obligations, its current debt obligations. So in essence, the whole theme of those ratios underneath there is they're looking at their current liabilities and current assets, that kind of stuff.
Tell them about the current ratio and why that's important in the short run.
Yeah, so current ratio, what that formula is basically saying is it's taking your current assets, so stuff like marketable securities, your cash, or any asset that could be consumed within the financial year. They're comparing that against their current liabilities, so the bills that the companies have to pay within a 1 year time frame. They're basically comparing that, and what that tells you is like, oh, for every dollar debt, how much, can our current assets cover that kind of stuff.
Right.
I have a question.
Yes.
So you mentioned that liquidity ratios are about like how well they can pay off debt. So
Yeah.
how does that differ from like debt management ratios? Because in my mind, liquidity is like how fast you can turn your assets to cash. So I guess.
Do you want me to go into that?
Oh, do you? I mean, if you want to.
Yeah, so liquidity ratios are just a metric of cash. In other words, if I have $100 million in cash, how quickly can I convert that? That's what the liquidity ratios are for. Debt is, can we afford it? In other words, can the company say, can I take on another 20 million in debt? What's that going to look like? That's the difference between the two.
Oh, thank you.
Well said, John. I don't think I could have articulated that quickly. But yeah, basically the difference between these two is you notice it's pretty similar, right? Like the current ratio takes current assets, comparing it to current liabilities. With the quick ratio, it's basically the same thing, except you're taking current assets and minusing inventory. So that's basically saying like, oh, if the company, say sales are slow, right? They can't convert their inventory to cash.
Mhm.
Can they still pay off their current liabilities? Or like, what does that look like? Like looking at their current assets, comparing it to current liabilities. My lungs. But yeah, okay, that's pretty much liquidity ratio. So quick ratio is more conservative than current because inventory is included as a current asset, but for quick ratio, they're subtracting it.
Yeah, it's that's a very the reason why it's more quick ratio than current is because those are assets that can be more easily liquidated than other assets like inventory.
Okay. All right, now for profitability ratios. So these types of financial metrics look at a business's ability to generate earnings relative to other metrics such as revenue, operating costs, balance sheet assets, or shareholders' equity. So here are some examples of ratios down here. These ratios, by the way, there's a lot more out there, but these are some common ones that I have here. So you got your return on assets that looks at the company's net earnings divided by total assets. So for every dollar of assets they own, how much, how efficiently are they generating, money using those assets? That's basically what that ratio is looking at. The higher the ratio, the better. Oh yeah, I don't think I mentioned it, but up here, the higher the ratio, like these ratios, you want these to be higher. Return on equity, that's net income divided by shareholders' equity. So equity, right? They're looking at how efficiently that company could generate earnings, given their equity. So given your money as the investor, how well can they generate earnings? That's what our ROE is. You could you could break down ROE even further into multiple components. This is called the DuPont analysis. So right here I have a formula. This is the 3-step DuPont, by the way. ROE could be arrived at by multiplying net profit margin times the asset turnover times the equity multiplier. So if you want to break down ROE even further, these are some components that you could break it down into. And yeah, pretty much I've listed out the formulas for each of these components. Yeah, that's ROE. Now we're going to move on to leverage ratios. This pretty much looks at how much debt the company takes on to finance its operations compared to its equity. So some common ratios down here is debt ratio. that looks at your total liabilities, so your total debt, compared to your total assets. So that ratio right there will pretty much tell you like, hey, for example, let's say the company has a total debt of 100 million, and total assets of 50 million. That ratio will come out to be okay. How's math work?
How does
Two.
math work?
2, right? So that ratio will come out to like 2. And what that means is like they have 2 times as much liabilities as they do assets. That's what that means. Yeah, down here, debt to equity, kind of the same concept, except you're taking total liabilities, comparing that to owner's equity. So that's your equity, every dollar equity. Let's look at every dollar equity you have compared to the amount of debt that is used. It's used to finance your operations.
Yeah, if you're gonna think of for the if I was gonna come up with an easier word for these ratios, liquidity ratios, just think what's it called? Capital readiness, profitability ratios, capital management, and leverage ratios is basically debt affordability. If you were gonna do that.
Exactly.
Now, to clarify for the ratios, is it going to be under 1 or above 1?
See, but
For that, it's really going to depend on the nature of that business. So I can't really set a hard number on what's good or bad, because it's really going to depend on the industry, your competitors, your peers. Because like, let's say an airlines company, right? They're going to use a lot more debt to finance their operations than say a retail store.
yeah.
So it's like, yeah, it's really going to depend on the industry and the nature of that business and the capital structure of that business.
Also think of like private equity. Do you know what private equity is?
They did. They watched the video.
Well, okay, but I just want to know if they know it already. So what do you, when you think of private equity, what comes to mind?
Like it's private, like not public.
company.
Okay. So private equity, if you're not aware, is the what's it called? The buying and selling of companies. So in other words, I'm taking out a good example of a deal that I could do is a merger and acquisition. An acquisition, I'm putting down mostly a little bit of my own capital and a bunch of someone else's capital. Where am I getting that from, right? I'm borrowing that money. It's not my own money. So a good example of a private equity firm would be one that's like maybe a 4 for that debt leverage ratio, which means they're 4 times over leveraged in order to generate a return. That's what private equity does. So those higher returns, that would make sense to have that as a metric, because to compare that to the airline industry where it's only like 1, you have to be careful with the ratios is what I'm trying to say. It doesn't make any sense to do that. So,
Exactly.
okay, I can take over.
Yeah, our next example, we'll go over some ratios covering Walmart and Target.
Yeah, this is
So
some of
their
the,
ratios. John will take over because I have to look at my chat sponsor. He's gonna go over some examples after this whole entire thing, like running through the whole 10K and 10Qs and stuff. Right?
right. Enjoy me while I'm here, because next week I'm not going to be here. I know. Cry. Sad.
Sure.
All right, so a good example, yeah, he talked about retail. Walmart, you shop there. What is Walmart? It's an everyday low retailer, right? You're not going to get a lot of growth there, not a lot of profitability. So that's why these liquidity ratios, they're under 1. They're not going to use a lot of debt to buy inventory. If it's a retailer, that's a problem, because I don't know about you. I don't know why a retailer would want to buy out that much debt unless they're gearing up for a massive acquisition. Profitability, their margins, like we said, are also very small. I think their average profit margin is like 3%. Leverage ratios under, debt to equity. That's a scary ratio for Walmart. Good Lord, 2. Sounds like I said, a private equity firm is like 4. Target, good example. Their ratios are not going to be very. Their current ratio makes sense that it's higher, closer to 1, because they carry a lot more liquid assets on hand, like inventory, clothes, that sort of deal. Profitability ratios, again, they're not very high, but that return on equity, wow, that's very attractive. Maybe I should invest for return on equity. That's a nice generation of capital right there. That's scary for Target. God, that's like a private equity firm. 3.49, what the heck? What do you need that much leverage for? You must be going through a buying process. All right, and then the financial analyst announcements, etc. We don't have any major announcements yet. Have y'all heard of the BCG, event that's coming up for Amplify?
Saw the text.
You saw the text? Okay, so Emily, if you're not aware of what that is, basically it's a trading seminar to see if you want to be an investment banking trader. So if you're interested in that, we'll give you the information for that if you have any questions. My phone number's on there, so y'all can text me if you want. Then we're having our stock pitch April 4th. I would recommend choosing your company by early next week and sticking with it, because We don't want people changing companies last minute, and that's going to be harder to do the math, when you're doing it last minute. And sign up for the stock pitch feed in the newsletter. This is our reference page. These are all the sources we use because, of course, we're the smartest guys in the land, but we're not the only guys in the land. So we got to use other people's sources, right? So this is showing you that's not all our work. Here's your study resources. I recommend using Investopedia. Visual Capitalist is good if you want a visual on the data. It's really good at displaying that. Morningstar, do y'all know what that is? Okay, so it's more for like looking at stocks and mutual funds, that sort of deal. LinkedIn Education, that's a paid course. You don't have to use that. YouTube channels, Finalis, that's a good one. Dividend Bowls, another good one. We also have our own, which is the FA Research and Trade. These guys do it better, arguably, but that's just because we're new to the market, as the saying goes. How Money Works, ooh, that's a good one. He has another channel called How History Works. He talks about all the trends in like education, business, finance, and the workplace. Yeah, also, I don't know y'all so much, so I don't want to just give y'all a book that you probably won't ever read. So if you have any questions about what kind of books to read for beginners, you can just come ask me. Newsletters, the Wall Street Journal. There's a good one for that because you can get a student discount. I've had that for a while. However, I will say it's hard you have to call them to cancel the subscription. So that's the only downfall with that. Compounded Daily, that's another newsletter. The Daily Upside, Short Squeeze. Those are all written by investment bankers that have their own YouTube channels. Weekly recommendations. Oh man, I forgot to put a weekly recommendation. That's embarrassing. Sorry. I guess read a newsletter per day. Read 3 Wall Street Journal articles if you can a day. I'll recommend that. And read the Finance Association weekly newsletter for updates. All right. And then here's our information if you want to go ahead and get it real quick. And we'll send you the what's it called as well. Do you want to take a picture, Emily? Okay. Do you want to take one, Rio? So let's take a photo. Anyway, we have our exit slogan, but we'll get to that in a minute. Cool. All right. Buy low, sell high. Fear, that's the other guy's problem. Don't worry about fear. All right. I've been to a dozen stock pitches. Everybody's always afraid that's what someone else is doing. My favorite thing to do is go around and screw with people and be like, I'm going to really knock your socks off. It's going to be great. So they were always so afraid. It's hilarious. All right. I think that ends the recording here.